What up, Hyperchange? Welcome to another episode. Today we're going to be talking about ARK Invest and the company's new research report on Tesla that values the company with a price target of $7,000 per share. That will be over $1 trillion of market cap in the year 2024. So that's a 5-year price target. It's got a bunch of different headlines. I was actually just at the ARK Invest offices at their brainstorm talking about this with Tasha and Sam. So shout out to the ARK team. Huge fan of their research. They've been very bullish on Tesla for years, extremely early in the story, extremely early, and be pretty much the only people on Wall Street to actually get what's happening with electric vehicles, especially with autonomy. That's been their sort of backbone of their price target and why they're so bullish. So big investors in Tesla. They put out this report, Tesla's potential trajectory during the next 5 years. Fascinating deep dive and sort of open sourcing of their model. I love how ARK open sources their research so we can all read it. That is super rare and just like what I think helps us all learn, moves forward the discussion. So really commend them for that. And they do I think they are working on like a GitHub, Excel, Google Drive-y sort of plug your own estimates in version of their autonomous model. It's not out yet, but I wish I could play around with that, but be on the lookout for that too. This is sort of an overview of what their model is spitting out. So I want to go through because a ton of you have asked me about my thoughts about it. So yeah, thought it was worth going through the report and checking it out. So let's dive into the report. This says Tesla's potential trajectory during the next 5 years. And they basically say, here's the headline that everyone's talking about. Our 2024 expected value per share is 7,000. To arrive at this case, they developed a probability analysis with bear, bull, and medium, I guess, estimates, and they sort of weighted each scenario of occurring. So we're going to go through all of those. Here's the $7,000 price target, which is based on the base case of their probability matrix. They have a bear case, which is a 25% chance that they think will actually be $1,500 per share, assumes no autonomy, so that's pretty interesting. And the bull case of 15,000, 25% chance of that, which means a lot goes right in terms of autonomy. So this is the chart of how they their model spits out the valuation of Tesla based on these given scenarios. So how do they arrive at these three assumptions? The key inputs going in their model, there's 3 of them. The first one is gross margin. Will Tesla's cost of manufacturing vehicles continue to fall in line with Wright's law? So this is this theory that ARK has been really the only one talking about, that as you produce more of a good, especially electric vehicles, the cost will decline. This is something they've been proven right with the Model 3 ramp. They've been very sort of ahead of the curve in predicting these cost curve declines based on Wright's law. Basically, as Tesla builds more Model 3s, as they get better at doing it, the cost to build each Model 3 will go down. Then they have capital efficiency. What is Tesla's cost per unit to build new production capacity? Basically, this is something we've seen huge improvements on with Tesla. It's been about 50% cheaper for them to build new production lines for Model Y in Gigafactory Shanghai than it was to build the Model 3 line at Fremont. Huge pace of innovation at the manufacturing level. Tesla's just getting better at building cars, smarter about how they set up production lines. That's leading to huge savings, which is going to have big impact on the financial statements because they don't have to depreciate and amortize, half as much capex per unit. So that's a real game changer here. Is Tesla's getting better at building cars. Their third here is autonomous capability. Can Tesla actually launch a fully autonomous taxi service? Of course, that's the big technological question. That's what ARK's model sort of rests on. So they bucket this in a couple different ways of looking at these different 3 levers. Gross margins, they say costs fall in line with Wright's law. Margins reach 40%, consistent with a dominant brand that is an innovation cycle ahead of commoditized competitors. 80% likelihood. And then they have a 20% likelihood that margins stabilize around 25%. I actually think margins around 40% is kind of a big estimate. I mean, right now Tesla's at 18.8% all in gross margins. I'll post the chart. So they would have to really move into software. I mean, I don't know if Wright's law is going to be enough to get them to 40% margins. I think even if Tesla was able to hit margins of that level, they wouldn't actually just make more profit. They would reduce the price to consumers. And so that's a different trade-off to get into. But this would be by far the highest gross margin of any mainstream automaker ever, which I think is possible. But I just don't know if 40% is, 80% likely. But that's what they have. In terms of capital efficiency, they basically assume that 11,000 per unit of CapEx expectations, which is roughly equal to Tesla's Shanghai Gigafactory. They think there's only a 50% chance of that. I think they could be downplaying this part of it. I think Tesla's going to continue to get rapidly more efficient in, capex per unit of production. It's going to keep falling. So I think ARK sort of underplayed that in this part of the model, while they overplayed gross margins. Autonomous capability, they think there's a 30% chance Tesla launches self-driving in 2021, originally charging $250 per mile, falling to $1 a mile, while taking a 50% fee. So I like they only put a 30% likelihood of this and a 70% likelihood they can't, but I also think, will they actually launch a commercial self-driving taxi in 2021? Definitely not. It'll be 2022, 2023 at the least. They could launch an Uber-like network with drivers in 2021, but that's not the same margin. And platform fee, I don't think it's going to be 50%. I think that's way too high. I think it'll be more like 20, 25%, but I don't know what Tesla said about that, and I don't even think Tesla's decided that, but those are just a couple levers to consider. Here is a little bit more detail on their different scenarios that they map out. As you can see, non-autonomous here in the bottom half, autonomous in the top half. They have the probability chance that this actually occurs, and then the cumulative probability, and then the 2024 price target. So the golden goose, Tesla lowers costs, builds factories efficiently, launches its autonomous network, $22,000 price target, which I don't know, maybe, but that would mean Tesla's like a $4 trillion company, $4 trillion company. I do think there's no way that happens in 2024. Like they put that at 12% probability. I put that on like a 0.12% probability, just because I think it's easy to model out on paper why this is worth so much, but to actually go to be a $4 trillion company, you need to be making $50 billion in earnings. I just think Tesla's so far away from that. That would be double their revenue that they did this year. But anyway, it's interesting to hear that they even have, without autonomy, Tesla could be worth $3,400 per share if they just get really good at building electric vehicles. So even if Tesla just remains an EV company, there's still tremendous upside and if they become the dominant new automaker. And that's something that I believe. So that gives me a little bit of hope of Tesla's like, we don't need this autonomous thing to play out right away for, there's still to be a lot of upside in the story. So here's some more interesting details on their bull and bear case. The bear case, 3.2 million cars sold. That's about a 6-tuple from what they want to do in 2020, 500,000. Average selling price of 52,000 per car, which is solid. That would result in 166 billion in revenue. This assumes no Robotaxi revenue, 33% gross margin, so a lot more practical than the 40%. EBITDA margins of 17%, which would be very strong, but I don't think are out of the equation. Then you're looking at a $300 billion market cap, $1,500 share price, so a double about from today. Based on this bear case of them just ramping production, but still no autonomy. If we get autonomy, they're basically saying they could build 7.1 million cars. The electric car revenue is 256 million, but the Robotaxi revenue is 351 billion, dwarfing the car revenue. Gross margins go up to 57%. You're looking at a market cap of $3 trillion as they're making, and a share price of $15,000. If they're making 33% EBITDA margins on, 5 or 600 billion in revenue. So huge divergence here. These are the numbers. Here's that a little bit more on Wright's law. I just think this is really interesting. And I actually think for Tesla to continue declining their cost to produce each vehicle significantly will need to incorporate Maxwell's technology. I just don't think there's that much more wiggle room out of the current battery technology to make it way cheaper, maybe a little bit with economies of scale. But the real breakthrough here is Tesla bringing their cell production in-house with the purchase of Maxwell Technologies, the dry battery electrode. Can get into that in a whole nother episode, but I think that could actually continue to drive down the production costs of their cars by making maybe the batteries are slightly more efficient, so they need less cells, which means the costs are cheaper, or it's just cheaper to produce because they don't need the drying ovens. Either way, I think the Model 3 cost decline curve will continue here, sort of in line with Wright's law. And they even do this other showing of the whole auto industry with Wright's law, which is interesting, a little bit more data there. And they do have, I love this stat here, globally automakers have manufactured roughly 5.4 million electric vehicles to date, less than 1% of the 2.6 billion internal combustion engine vehicles ever produced. It's important to put in context how early we are in this electric vehicle technology really proliferating, and how early that means it is in developing and getting better and getting cheaper. So I think we still have, a decade of like significant improvements in ironing out this technology, especially for all the legacy companies, to make, way more compelling electric vehicles over the next decade. While this ICE, technology stays stagnant, electric vehicles technology gets cheaper and cheaper, that we're crossing more and more of that inflection point with the industry that's going to turbocharge adoption of electric vehicles. And so in their bull case, ARK assumes that Tesla will basically get 15 to 20% of the global electric vehicle market. So that's what's interesting about this, is they're still kind of pitching Tesla as the Apple of the automotive world, maybe a higher end sort of, tech-focused brand that doesn't need to get the whole market, but owns what they do and does it really well and is super profitable. And then here they have this cool chart, which I like the bottom part, where they talk about the dollar signs of each one of their cars. They talk about the mass market sedan, mass market SUV. As you can see, the addressable market for those like 14 million to 17 million. That's where the real money is going to be made in the auto market for Tesla. And I think, I put this in my fully charged pitch. I think that picture we got in China about the design center in China, them wanting to build this new car that looked kind of like a compact version of the Model 3, or Model Y, sort of like a micro, I'm calling it the Model 2, $25,000 or so car. I think that actually has the potential to be Tesla's best-selling car in the whole company in 5 years if they start building it soon. And that would be attacking these two huge markets, mostly sedans and maybe micro SUVs, that could really drive Tesla's unit sales to over, potentially an addressable market of 10, 20, 30 million per year. In terms of the autonomy piece, this is really my big question. They provide a little more clarity. We assume that its autonomous taxi service will begin in 2021, 1 year after Elon Musk predicted the service will be available, regulatory approval permitting, with just 2% of eligible Tesla vehicles on the road on the network in the first year. So, that means if you have like 1.5 million Teslas on the road, they're projecting about 3,000 robo-taxis on the road in 2021. That'll be 2% of 1.5 million. I don't know. This is the part of the model where I just don't get it. And I think this is where, and they have this amazing chart that says cash generated from autonomous Tesla network into investment in more factories, which means more autonomous Teslas, which means they can make more factories. Love this flywheel chart. Love this image. But I think there's the big question for me in all this, and I think ARK directionally is nailing it. And like their whole thing about Tesla's leader in self-driving. This is a massive opportunity that people are totally underpricing, totally underappreciating. It's going to change transportation, is right on. But will this launch in 2021? Will Tesla's Robotaxi network be a needle mover financially for the company in the near term? My answer is totally no, unless you start to assume that as the features go up, Tesla can raise that fully self-driving price and then actually capture more near-term margin from selling cars with this added software component. I think that is a real story in the near term that's playing out that could drive upside of the gross margin and cash profile of the company as Tesla moves from 18.8% gross margins towards that ARK goal of 40. I think increasing self-driving features is a huge way to do that. But this idea that they're going to have a level 5 or level 4 network that I'm going to be able to just press a button and get a car to come to me autonomously and drive me around, and Tesla's going to get a 50% cut and they're making billions from this. Like, I just think that's so far away, and there's so many things in my brain that I see, is that going to be legal? Are regulators going to get on board with that quickly? What kind of data does Tesla need to even get there? They've hit 3 billion miles on autopilot. Elon Musk has said it could take tens of billions of miles to convince regulators. They're collecting 2 to 3 billion miles a year at this rate. So even just based on data collection to get to 10 billion miles, you're looking at maybe a 2022 best case scenario for Robotaxi, which is a year later than ARK. The other totally interesting thing about this, that I think Tasha Keeney actually asked Elon Musk about on Autonomy Day, was whether they would be able to launch the Tesla network with drivers in the front seat, essentially just basically replicate Uber's app, but with people driving their cars mostly on autopilot, because they'll navigate on autopilot on city streets. And then you could start to build out the network, trial it out, get in with regulators, basically do a dry run of the network without robo-taxis. And then as the software updates come, you start making these cars more and more autonomous. People have to do less and less. So I think that is actually something I'm watching very closely, and I feel like that could launch, the autonomy Tesla network with drivers in the front seat could launch in 2021, and that'll be the first real step towards getting to this true robotaxi network. But the way I see this playing out personally is it's more like 2022 when Tesla launches its Uber-esque competitor, and then maybe 2025, 24 when there's actual true autonomy in these rides. And then that's when the margin starts getting. So I think this autonomy business actually just starts scratching the surface in 2024, 2025, barely a needle mover. And so I don't think it justifies this $1 trillion valuation when it's just going to be barely scratching the surface. I think if we stretch this out to 10 years and we look at 2030, I think there's a way better chance that Tesla's deployed, 1 million robo-taxis or 2 million of these robotic taxis that are generating $100,000 dollars a year in revenue, making Tesla hundreds of billions in revenue, 50 billion a year, 100 billion a year in profit. I think that's a decade move, not a 4 or 5 year scenario. So that's sort of my thoughts on the ARK investment, but I hope I'm wrong. I mean, hopefully the development of this technology is sort of way more exponential. It does get way better. Although I think on the conference call, it's interesting to see Elon walk back, it seemed like, the timeline of fully self-driving, navigate on autopilot streets, just seem to be taking a little more cautious approach with that. But at the same time, all that matters is Tesla ahead? That is really what matters. And my theory is they're so far ahead. Just it's hard to even wrap your mind. Nobody's even started the race, and Tesla's been sprinting for like 4 years. That's how far ahead they are with just the chip. They're vertically integrated, the chip, the sensors, the data. There's just no one that's even close. And so that's my thoughts on the ARK model. Would love to know what you think in the comments below. If they release it, I'll definitely add that to the comments and tweet it, or maybe make a new video about plugging in my real estimates into ARK's model so we can see what sort of numbers that puts out. But I think directionally, ARK is right on. Super refreshing to see research like this from sort of more traditional Wall Street side. Just a huge fan of what ARK's doing, and I think huge props for putting out this report. Anyway, this is Hyperchange. I'll see you guys next time. Huge shout out to our Patreon supporters, producers, fun in the channel. Peace.